Nigel, many thanks for making time to speak to us. If I didn't know better, I would think you just walked away from the wedding with that tie.
That's very kind of you.
Well,
unfortunately, the invite was lost in the post.
Blame it on the Royal Mail, hey? They're losing it. First of all, it's very interesting. I'm going through your report. You do mention UBS Kwekwa Boli. I had an issue with this particular case because instead of declaring that, concealing some of the deficits here, which were close to $2 billion US, this is fraud. It's not someone not declaring, it is fraud. And how do we draw this thick line between someone using the right lingo, like a lawyer, that this is fraud, as opposed to something like declaring?
I think it was certainly a case of fraud. And what we see is the fraud was a result of poor controls and a breakdown in the control environment. So one thing leads to the other. So perhaps the initial intentions weren't to be fraudulent, but the environment was insufficient and inappropriate to restrict that prohibited activity. And the breakdown in that did lead to fraudulent behavior.
And I like that you bring up the control environment, the regulatory environment. Would you say it's something that needs to be changed, because we are seeing more and more cases of accounting irregularities coming out and really little being done in the financial markets to really change the regulatory landscape?
There are certainly cases near and far at the moment of accounting irregularities. The regulators appear to be doing a good deal in this space, but there can always be more to be done. The regulatory landscape, as it appertains to asset management, is constantly evolving, and it becomes important for asset managers to be aware of emerging risks and how they manage and implement the right processes and controls to facilitate their ability to be able to work with new regulation.
Nigel, something that's quite fascinating is I've spoken to a few Chinese lads over the years, and one thing that they actually mention is when investing in many of these developing countries, they look at fraud as an operational cost. And that is the cost of actually getting the deal through. I'm going to grease a few palms and we're good. And that's how they actually look at it. How do we change that mindset?
Well, certainly, as we look at certain emerging markets, that may be a view of some people. Our prudent view is, of course, that in no circumstances should that ever be accepted, or is that right? It's interesting as we look at China, for instance, with the recent changes and the stamp down that has been put in place on stamping out corruption. The government has made a move to no longer make this an acceptable form of behaviour. As we conduct operational risk assessments or operational due diligence, an integral part of that is looking at an asset manager's policies and controls surrounding gifts and entertainment, accepting of bribery and such like. We should never view it as being part of the cause of doing business, or indeed acceptable.
Now, another risk that you've mentioned in your report is the emergence of automation, cybersecurity issues. I'm sure big data falls in there as well. How do we manage this risk for investors?
Asset managers, on behalf of their investors, must manage it very carefully. The risk of cybersecurity is no longer emerging, for instance. It has emerged, and it is now very much a business imperative. Once again, on regulation, as we look on cybersecurity to the upcoming implementation of GDPR in Europe, this is a piece of regulation on data protection and on the control of what happens in the event of data breaches, and the obligation on asset managers and other organisations to disclose information relating to those breaches. This is a piece of regulation that not only affects Europe as a geography, but indeed is far-reaching and global in its ambit. So it becomes imperative that businesses, indeed the C-suite within asset management organisations, manage the emergence of these regulations very carefully.
What if there was more caps on capital requirements? And I say this in retrospect to maybe the Dodd-Frank, which does draw a very thick line between what money you can invest and what funds you cannot invest. And what if this is actually reflected on asset managers?
What we would always make clear to institutional investors is that they need to invest in a manner that is right for them. They should only ever select an asset manager and a strategy that is in line with their risk appetite. So if capital requirements form part of that risk appetite, then that should focus heavily in their manager selection considerations.